In this lecture, we're going to study the relationships between bonds, interest rates, and inflation. So this is actually a very key set of relationships that everybody should understand, because then you actually have a much more better understanding of the world we live in. Let's look at this. This is a very interesting phenomenon here. First of all, when a bond is issued, it's issued with a interest rate. And this interest rate does not change until the life of the bond. Okay, so if it's a 30-year bond, then for 30 years, that interest rate is fixed. So bonds are generally married to the interest rates when issued, and there's no such thing as a divorce. So then, why do bond prices move up or down? Why do we have a bond market where bonds are traded actively on a daily basis? Why should the prices of these bonds move up or down? So consider today we bought a bond. We bought a $1,000 bond, and let's say it was a 10-year bond, so it will expire in 2026. So it'll expire in 2026. You'll get your principal back, the $1,000. And meanwhile, we'll be picking up about 4% interest all the way. If the Federal Reserve increases interest rates, we just saw the first interest rate hike in December of 2015. Now, let's say the interest rates are now hiked up and the interest rates go up to 6%. Okay, so we bought the bond at 4%. So we are going to get 4% only until the life of the bond. But in the market, things have changed. Whatever it might be, we don't need to be concerned. But whatever it was, it caused interest rates to go up from 4% to 6%. So now, if we wanted to sell our bond in the market, that bond is fetching only 4%. So why would people buy your bond? And you probably are asking $1,000 for it because that's what you paid for it. Why would they buy your bond, which is only giving them 4%, and they have to pay the same $1,000 because they can go out in the market now and buy a $1,000 bond and get 6% interest for that same bond. So they wouldn't pay you $1,000. It's clear. Because your interest rate is lower at 4%, they would reduce the price of your bond. So the price of the bond might be $950 instead of $1,000 because you're going to have to give up that. So as interest rates increase, prices of bonds come down. And as interest rates decrease, prices of bonds go up. So this is an inverse relationship that you have to understand between bond prices and interest rates. So consider a seesaw in any park. On one side is bond prices, and on the other side is interest rates. If one side goes up, the other side must come down. So this is a key relationship between bond prices and interest rates. When interest rates go up, bond prices will come down because that's the mathematical relationship that's built into the structure of the bond itself. When can interest rates go up? Interest rates can go up because of inflation. Why is the Fed increasing interest rates last December? Why did they increase it? Of course, they're increasing it because one, it was long overdue, and two, the situation is changing. So the US economy, at least based on some numbers, looks like it's on the growth path again, and unemployment is down. And so it's time to raise interest rates because as the economy grows, more money is floated into the economy, and that's what causes inflation. So inflation is just too much money supply. So if everybody's making money, all the executives, companies are making money, people are getting good salaries, businessmen are making money, shopkeepers are making money, small businesses are making money, then that's what creates inflation because all this money is now coming into the market and it's being spent on everything, and there's a high turnover of money. So the churn in money, how quickly it moves from one hand to another hand, is a measure of inflation because the more money there is going after goods and services which are somewhat limited, that's what creates an upward lift in prices. And so interest rates can go up because of inflation. Although inflation doesn't have a direct relationship to bonds, inflation causes interest rates to go up, and the fact that interest rates are going up, then bond prices come down. So that's the indirect relationship between inflation and bond prices. Now you also have to look at nominal and real returns, right? Because this is exactly why inflation creates an upward lift in interest rates. Because let's say you're making 4% on the bond and inflation is at 2%. So basically your nominal return is 4%, but your real return is the 4% minus the 2% inflation, so which is 2%. Now let's say inflation goes up from 2% to 3%. Then your real return is only 1% now. And if inflation goes up from 2% to 4%, you don't have any return. You have a zero return. So how is this matter going to be resolved? It's going to be resolved by interest rates rising. So interest rates will then, if there is too much inflation, interest rates will automatically be raised by the Federal Reserve to tackle inflation. So as interest rates go up, then borrowers find it a little bit more painful to borrow money because when interest rates are low, people are going to borrow a lot. When interest rates are high, people curtail their borrowing. When they curtail their borrowing, there is less money floating around, and then automatically inflation comes down. And this is how the whole cycle moves on and on. So inflation reduces real returns and therefore results in a higher interest rate. The second thing that affects bond prices or interest rates is higher credit risk. So this is just like our personal credit cards. If your credit risk increases, so basically if your credit rating, let's say if it was 700 and for some reason it dropped to 600, then people are going to charge you higher interest rates. So it's as simple as that. The same principle works even for countries and companies. That's pretty easy to understand. So if a country goes into a credit risk default risk, then they are going to have to give higher interest rates. So Greece, for example, during the Europe crisis last year, they were paying 25%, and Venezuela is in the same category. So there are many countries that are deemed to be high risk, and so they have to have high interest rates because no investor is going to invest in a Greek bond if they pay only 4%. No, because for the higher risk, they want a much better return. They want 25%. So that's basically how everything sort of ties in together. Bonds, as I told you, we are on a 30-year bull run. Interest rates are at an all-time low. So this is the relationship between bonds, interest rates, and inflation. Hopefully you have a good understanding of this because this is a very key concept. Next time you hear some news items on these elements, it will start to make a lot of sense, and the whole financial world itself should start making a lot of sense once you understand these relationships. In the next lecture now, we're going to look at the Federal Reserve, the ECB, the effects of money printing. What exactly is all of that? And how is this all going to play out? Because this is also a very important macro issue that we should understand. And then, of course, we'll show you some bond trading instruments. You already saw the futures, but we'll also take a look at a couple of others. Thanks.